Hey, Mike Swans here. I just did a little bit of a trade today in my portfolio. I'm going to show it to you and tell you why I'm doing it. Anyway, this is Google Finance, where we're going to enter in the trade right now. I did it today on the 2nd, and I did SDS. And, oops. Okay, the symbol, 2,000 shares at $15.405. That was the average cost and includes commissions. Deduct from cash in the portfolio. And SDS is the ultra short S&P 500 exchange traded fund. It's up 14 cents today, but it's actually a little bit below what I got in at the current moment. So anyway, let's talk about it. Let's look at the charts first, and we'll talk about today's news. But in my view, the market is in a correction. It's been in one since the spring, and we've bounced up the past 2 months. And this last bounce has come to an end around the 1,400 level S&P 500. And I believe in August we're going to correct back down. So today I basically took a small trade position against the market. I only did 2,000 shares. And in my mind, I'm putting a wide mental stop of way above here where I'd get out. You know, maybe I'd lose $2,000 on this 2,000 share trade. If it works right, you know, make $6,000, $8,000, $10,000 potentially. But I'm not taking a big position. I'm just sticking my toe into the market. In a few months, I do anticipate I'll be investing all my money, I believe, for the long haul. But this is a simple trade just to get things going and start doing stuff together, really, more than anything else. So anyway, as you know, last week the stock market had a pretty big bounce on nothing but rumors that the Federal Reserve was going to start quantitative easing and the European Central Bank was going to announce some sort of similar program. And of course, the markets rallied into that news, and it didn't happen. The Fed did nothing yesterday, and today the European Central Bank did nothing either. It just simply talked about doing stuff later on. Here's a news article about it. Over the coming weeks, we're going to design some sort of bailout program, but it didn't happen today. So some people are disappointed at the moment. The S&P 500 is down about 8 points. Now, I would have liked to have, you know, in a perfect world, have taken this position a couple days ago, but and if I did it close to 1,400, I would have done more than 2,000 shares. But I just did a small position so I can just, you know, not even worry about it at all. Just try to make a little bit of money and give myself plenty of room where the market can go back up for a couple days, and it won't bother me at all because I'm putting a mental stop way up here. So I won't get shaken out of the position. If I did a huge position today, trying to make a huge amount of money, which I don't think is really warranted in this type of market, then I could easily get shaken out. But there's less chance of that happening. But bottom line is, the central bank's disappointed. The market rallied into that. It's really been rallying for 2 months, and I think we're going to correct back down in August and take a lot of the profits we've seen in the past 2 months away from the stock market. In fact, if the situation in Europe really deteriorates, which could happen in Greece or Spain and Italy, the bond yields could shoot back up now over the next couple of weeks, then we could suddenly see the stock market drop down here, in which case I'd probably just take profits. You know, look at last year. The stock market just crumbled in a matter of a couple of days because the European debt crisis broke wide open, and that could easily happen in Greece. If you look at Spain, for example, it had a huge bounce last week. This is this EWP, the Spanish ETF, and today it's down 5%, or 4% at the moment. GREK, which is the Greece ETF, I actually tried to short it right on the open, but I wasn't able to get filled because it doesn't have a lot of liquidity. I was really trying to take advantage of that fact and get in at a silly price, but no one ate my shares, but it's worth a try. But anyway, this is the Greece ETF. It bounced up in June after the Greece elections, and last week it barely bounced at all, and I believe it's in a position to just go right back down. In fact, I think Greece could be defaulting in a matter of 6 weeks or sometime in September even potentially. So that's a situation I'm looking at. And in my view, a lot of people got excited. I think too excited because of this bounce, and they got in their mind we're all of a sudden going to have this big bailout this week, which isn't happening. And in fact, I think what's real noteworthy is that the European Central Bank didn't buy Italian bonds today, didn't buy Spanish bonds today, and I think it was probably, the press rumors that we've seen were that they were trying to make a deal in order to do that, and they failed. And I think what that means is they're not going to be able to do a deal to bail out Greece. So if they can't get the political will to bail out Spain and Italy, they're not going to bail out Greece. So I think Greece is in trouble, and we're going to get bad news from that. So that's why that's one reason I'm taking this short position against the broad market here. But one thing I want to emphasize with you is that these markets, in my view, markets don't just bottom one day on some news and that's it and go up forever from there. And a lot of people are starting to talk as if that was about to happen. Instead, bottoms kind of take place over months, and I think we're starting to actually see that process in different markets where they're starting to bottom out and enter a transition of basing that precedes a new bull market. And I even think this could be the start of a basing phase right here that could go on and at the end of the year, turn up into a new bull market. For example, this is SEA, the shipping stock index. It appears to be basing out, and I think can easily turn into a new bull market before the year's over. So these are things I'm planning on. I think I'll be investing in sectors like this, sectors in Europe, gold stocks, later on as they complete a transition from a stage 1 base into a new stage 2 bull market. And when it comes to the U.S. market, we're in a sideways range here, 1425 being the top of that range, and so far this year, and then 1275 being support now. And I think we're now going to take a move back down to support, as over next month we're probably going to see some more bad news in Europe, probably centered around Greece, impact the markets. So I'm just taking a small position as a way to play that. Later in the year, I do think I'll be taking big positions. At some point I may be fully invested in my account, even on margin. But right now, we're not in a market environment that justifies that kind of thing. Now, to talk about the real short-term intraday action, the market gap down. Often when you get a gap down like 100 points on the Dow, which is what we saw, the market tries to bounce back in the first couple hours of trading. So we're probably going to see that. In fact, we could even see the market go into the green today, maybe even bounce up again tomorrow. And it may not do that. It could just continue to sell off. I don't know. That's real tough to it's guessing on such short-term hourly moves. The weekly trends are easily more identifiable, and that's where the real money is made in the long run. So I'm taking, I'm not trying to time the exact tops or the exact bottoms with this trade here. I'm just taking a position because I think, what we've seen in the news is harmful for the market over the next couple of weeks, and I think the potential upside now is very limited. Yeah, we could get some good news from some earnings or something tomorrow, get a gap up, I don't know. But I'm just taking a small trade, a small position to ride what I think is going to be a correction over the next couple of weeks for August at the minimum. So anyway, that's what I did today, and I'm going to do a much bigger update with the monthly newsletter, which I'll be putting out this weekend. So be talking to you later.